So without further ado, except just maybe I'll show you our Stonehaven important notice. Just keep yourselves, if you could, on mute. There'll be a lot of time for interaction a bit later. This is being recorded. And as it says here, we may invest or represent clients, and these are two clients. But I've asked them not to pitch, but to teach. And in that spirit, I'm going to turn it over to Ben Foreman. And actually, Ben, I think you want to take control of your slides, so I'll stop sharing and let you do that.
Can everyone see my screen?
Perfect.
Perfect. Great. Well, thanks, Mark, for the opportunity to be here today. My name is Ben Foreman. I am the founder and managing partner of Parify Capital. We are an investment firm that is focused exclusively on investing in the blockchain and digital asset ecosystem, with a particular focus on the idea and intersection between financial services and blockchain. So this kind of intersection and convergence of fintech and the digital asset space. But today, I'm not going to talk about Parify or my personal background. I want to dive deep into this idea of decentralized finance and blockchain. And so I wanted to start just by posing a very simple question, but I think it brings to light an idea, which is, if we were to redesign the financial system from scratch, would we build the same system that we have today? And if you think about the financial services space broadly, it's 8 to 10% of global GDP. And it's a huge kind of cross-section of the broader economy. But if you really think about how much underlying innovation there's been at banks or across global capital markets, it really has not modernized alongside the internet in the same way that other sectors of the economy have. We still don't have an Amazon-like experience for finance. You know, you can order an Uber to your home, you can get delivery. The internet's produced a lot of magic and disruption across a variety of industries, but the only department at banks that's grown over the years are legal and compliance. And so I want you to keep this question in the back of your mind as we're kind of going through the presentation today. So there's a new emerging area that's called decentralized finance. Some people call it DeFi for short. And it's an area of the blockchain space that has found real adoption and product market fit over the past several years. The idea of decentralized finance, and we'll get into this shortly, is it's a new open architecture for creating financial applications. These applications are built on top of neutral databases like Ethereum. So think about it as an app store, but there's no Apple behind it. Anyone can build an application and launch it globally. These applications, we'll get into it more, are permissionless to access. They are completely transparent and open, and they run 24/7. And if you think about what these applications are, and it's this idea of taking things that you can do in the traditional financial system and unbundling them. So it's unbundling the traditional financial stack. So I like to call them kind of the ING verbs of finance: lending, borrowing, hedging, insuring, indexing, exchanging, things you can do in the traditional economy that are running through custodians, broker-dealers, intermediaries, banks. You can now do peer-to-peer across DeFi. And so I think it was Matt Harris at Bain Capital Ventures that said that fintech is the fourth platform of the internet. So if you think about kind of the internet, the four platforms, the four waves, the first was the internet itself. The second was cloud computing. The third was mobile. And he and many others are beginning to believe that really fintech is kind of as important as those first three buckets. The issue, I think, with most fintech companies is that they're not really 0 to 1 improvements. They're taking existing financial services and making improvements really on the margin. They're digitizing banking experiences. They're making it easier to buy stocks, but it's not reapproaching the underlying problem from a first principles basis. Most of these systems are still built on top of the rails that were constructed in the 1970s, the SWIFT banking system. They tend to be regionalized, and they just tend to be kind of improvements on the margin. So if you think about the financial stack today and what DeFi is, it's really open source software meets finance. And a few kind of properties or ideas come to mind as you think about kind of what makes it interesting. So one is these applications or networks are completely permissionless to access. So if you have a mobile phone, you can interact with a borrowing and lending application, or you can send money and effectively become your own bank. So there's no login information required, and they're completely open. They are counterparty-less, so you're not directly giving your funds to a custodian like you would if you bank with JP Morgan or trade stocks with Fidelity. There's no counterparty that you're facing off against. So everything is kind of completely peer-to-peer. And these systems are completely transparent, so anyone can look in and see the underlying risk of these networks in real time. It's not, like a bank where you get, limited visibility into what the underlying risk is. And there's consumer surplus in these networks. So these applications have no board of directors, no management team, and they are limited in terms from a rent-seeking standpoint. And so that produces a tremendous amount of consumer surplus, given kind of the lack of overhead of these networks. So if you kind of think about where things are beginning to evolve, you're seeing firms like Fidelity, Robinhood. You recently saw news with PayPal and Square. They're increasingly interested in making investments within the decentralized finance space. I think what you're going to begin to see is these firms are going to be leveraging decentralized finance infrastructure effectively as a back end and as kind of an underlying API layer to conduct their affairs. And really, it's a margin improvement and an efficiency play for them. And it's a way to offer users higher interest rates, new products, and it allows them to effectively disintermediate other rent-seeking components of the financial value chain. To be clear, I still think banks and traditional finance will exist, but it will really be built on top of these new rails. One example recently that comes to mind is the PPP loan disbursements in the US. It cost the government $250 million to send $2 trillion. So 2.5 basis points. I mean, they were sending ACH transactions, checks, prepaid debit cards. A lot of the money didn't reach their intended recipient. And, to be living in the year 2020 and not be able to efficiently send money and have there be kind of that much of a price tag is really just one example of many on how inefficient the existing system kind of still is today. So taking a quick step back, I'm sure many people have been following crypto or Bitcoin and blockchain over the last 12 years. Bitcoin launched in 2009. Most people didn't really take notice until 2017 during the price run-up. I think a lot of people only know about Bitcoin, think about it as a call option on digital gold. And there are probably some who say, hey, it's not Bitcoin, it's blockchain. Broadly speaking, if you step back, we are really very early in really what's becoming a fairly heterogeneous and diverse asset class. So there are over 4,000 different digital assets. you're starting to see very meaningful capital come into the space. This is roughly a $400 billion market today. So it's about half the size or third of the size of the US high yield bond market. And it has high absolute returns and also liquidity. So it has this kind of interesting combination of venture capital upside and public market liquidity. This space is very diverse and broad, and I just want to make the point that there are 4,000 digital assets. The ecosystem is just much bigger than Bitcoin. Here's a chart that shows just the decentralized finance ecosystem on top of Ethereum, which is one blockchain. There are asset management products, derivative, fixed income tools, peer-to-peer insurance networks, and virtually every one of these applications has a digital asset backing it that resembles an equity-like security. So what's unique here is if you think about the internet, you actually couldn't own a piece of SMTP or HTTP. You couldn't own the underlying kind of base layer or protocol layer. All of the value of the internet was created in the application layer. In Amazon, Facebook, Salesforce, Netflix, trillions of dollars of value was created kind of at the application layer. What's unique in the blockchain space is these protocols that are launching are effectively investment opportunities because they're digital and they're scarce, and that scarcity component gives them value. And so in that sense, this is kind of an entirely new paradigm in how digital infrastructure can be monetized. What's interesting about this space and in terms of how it's evolved is you can actually run discounted cash flows, look at price to earnings ratios on digital assets. Most people think about gold and say, hey, gold is 2% of Bitcoin's network value. And so, if it reaches gold parity, there's 50x upside, and maybe Bitcoin's going after an even larger market than gold. But at the end of the day, you can't apply an intrinsic valuation analysis to understanding what Bitcoin should be worth, just like you can't run a discounted cash flow to understand what the Australian dollar is worth. Currencies and commodities can only be priced relative to one another. They can't be valued. Now, the reality is in the digital asset space, you're starting to see a number of different digital assets. The majority of the market actually resemble equities. So if you own one of these digital assets backing a decentralized finance application, you're entitled to your pro rata share of fees or cash flow generated by the network. And if you kind of think about public equity markets, you get 4 snapshots a year of earnings, 3 10Qs and a 10K. In this market, you can monitor earnings in real time. These systems are very data rich. You can see user activity, volumes, earnings, et cetera, and monitor them on an ongoing basis. So if you think about kind of this idea of smart contract earnings behind these networks, it's increasingly kind of becoming non-trivial in terms of the dollar amounts. So we've picked a collection of our of some of the names we monitor in our coverage universe, and as of September, they were generating roughly 80 million of revenue on a run rate basis. So call it $1 billion annualized, and that number kind of continues to grow as more capital comes into space and more users get involved. I'm going to skip over this slide because I think I'm running short on time, but the one thing...
Ben, take your time. This is important.
Okay, well, I'll just highlight this. I like to give an example of like, why does this matter, right? Like, why does blockchain matter? Why does crypto matter? I mean, I think our ongoing assumption at Perify is that no one cares about blockchain. Like, no one cares about crypto. Like, people don't. People care about products and services that actually make their lives better. And so blockchains are inherently more difficult to use than traditional financial products today. And so they really have to offer a 10x, let's say, improvement in order to compel people to actually like download a MetaMask wallet or download the infrastructure to use these systems. And so if you think about an example of this. So there's this idea today of a stable coin. And today there's roughly $20 billion of stable coins that are issued on top of Ethereum. This time last year, that number was about 3 or 4 billion. This time the year before, it was about 2 billion. And what we're seeing is the idea of a stable coin is you have a digital asset that is redeemable for $1, but can be sent and can leverage the efficiencies and rails of a blockchain. So it's easier to, the idea here is it's easier to send a stable coin, a digital dollar, than it is to send a wire or an ACH transfer, particularly if you're a business that wants to pay an international vendor or wants to pay distributed workforces. It's just more simple, more efficient. It's effectively instant, effectively free, and you have an independent audit trail. So in our business, we use stable coins to pay invoices. Many firms in the crypto space are already using kind of stable coins just in their day-to-day operations. And what we're beginning to see here, which is I think is very interesting, is there are firms like Circle, for example, which is backed by Goldman, that are building software products where users that aren't in the crypto space are using the software to settle invoices and pay international vendors without even knowing that they're using stable coins on the back end. So it's effectively all abstracted away from the user. And I think stable coins are this just like very interesting use case. You've seen just a ton of growth. They're kind of very common across decentralized finance applications. And with JP Morgan launching its own stable coin, many central banks now, Jay Powell at the Fed, Carney at the Bank of England, and you saw the PBOC recently talk about a digital renminbi. I think you're going to start to see just an influx of many different stable coins come into this market over the next couple of years. And they're all going to leverage the infrastructure that exists in the decentralized finance space. So I just want to end with this slide, which is the idea here is, when is this going to play out? Like, can you kind of wait around and monitor the space and kind of wait to see traction and then jump in? So if you look at kind of other technology trends over time, whether it's electricity, the radio, the television, there are a couple interesting things to think about. So technology trends and adoption have accelerated over time. So if you look at the lines on the right-hand side of the page, you can see there was like less of a adoption period. There was kind of a steeper curve. So the derivative of growth was much steeper. So technologies today are being adopted much more quickly than they were, say, relative to kind of the 20th century. An example of that is, the telephone first appeared in homes in the US in the 1900s, but it took until the 1960s for the telephone to reach 80% penetration. Now, if you think about blockchain, software grows faster than hardware. You can take something like Facebook. Facebook launched in 2004, and today, 14 years later, has 40% of the globe is on Facebook. And so there's no hardware or infrastructure required. This isn't the automobile where you need an entire physical value chain in place. Everyone has a mobile phone today and can download an app and immediately start interacting with the blockchain. So the barriers to adopting decentralized finance and blockchain are incredibly low today. And so I suspect that things are going to move very quickly. The Hemingway quote, "Gradually, then suddenly," kind of comes to mind here. So I'll kind of pause, and I don't know if we're going to Q&A, Mark, or if we're saving that till the end.
So we're going to do one or two questions because we're going to pivot so hard with Hamlet, and then we can come back together and see how these worlds interconnect. So a few questions if anyone has any. I saw some in the chat. One question was from Ned in San Francisco, who comes from banking or financial services compliance. Of course, he's going to ask about regulation. Maybe you could comment on that, Ben.
Yeah, so we spend a lot of time talking to regulators at FinCEN, SEC, CFTC, and the idea here is, regulators. These systems are kind of in a gray area because there are oftentimes no companies behind them. There's no CEO to kind of write a letter to or issue an information request to. These are kind of distributed systems that live on servers globally, and they're difficult to regulate. And so it poses a new challenge for regulators. What I've kind of gleaned from my conversation with regulators is that they're very interested in this technology. Hester Pierce at the CFTC has kind of been a thought leader in Washington around blockchain. And the idea here is like, I think regulators want to keep the innovation that's taking place in the space within the US. And I ultimately think that regulation will be a big tailwind for the space and for this technology, because it will provide clarity in terms of how people can interact with these networks. So I think, there's uncertainty today, just like there was kind of uncertainty with Uber, where they like permitted to operate without taxi licenses, or Airbnb. There was and continues to be uncertainty around many of those kind of disruptive businesses. I think it's really no different here. There is some uncertainty, but I think like when you have a technology that just makes people's lives so much better, it's very difficult to just kind of slam the door on it. And I think so. I think it's a risk, but it's also an opportunity as you think about kind of a lot of the activity in the space.
And hi, this is Gary Brock. I have a question. What about quantum computing and its ability, in nefarious hands, having the ability to break the block?
Yeah, I mean, so that's a risk to blockchains broadly that, is kind of like a known unknown to some degree. If you think about quantum computing, could it ultimately like trigger a 51% attack on one of these networks? I think it's possible. And so that is a risk. And I'm not an expert on quantum computing, but I've talked to a lot of experts and gotten very mixed opinions on what that looks like. Today, to launch a 51% attack on Bitcoin, you would need to have like 100 times the computing power that Google has. So it would take some sort of like coordinated effort by state actors to have enough hash rate to, basically create a double spending transaction on Bitcoin. So it's a risk, but it's kind of like one of those unknown, unquantifiable risks.
Bill Doikler, do you want to voice your question?
Do you want me to ask it directly, or I sent it in the chat itself?
Yeah, I'll build that.
Effectively, how are we going to bring liquidity into the space after dealing with the effects of the crypto winter, failed and abandoned startups? And, particularly in the family office world that I'm in, are we tracking real companies with real leadership and real revenues that are presentable and that can become the benchmarks in the industry?
Yeah, so, it's interesting, like in the crypto space, it's a great question. In the crypto space, price tends to move like this, but fundamentals have tended to track very much kind of up and to the right. And so like, I think to me, like the most important KPI for this space is human capital. So you've seen, engineers from Facebook and Google and Uber all start building products in the space. And there's a tremendous amount of underlying development. I think if you look at the internet, there were, for every 10 companies that was around in 92, maybe one of them is still around today. So there were a lot of people. That's kind of the cost of innovation. Is if you're in a new industry, there are going to be lots of failures, lots of ideas that are tried that don't ultimately work out. But, make no mistake. I mean, what is happening in the space today is very real. I mean, these systems are being used today. They're generating meaningful revenue. People are using decentralized finance and blockchain without really even knowing they're interacting with these applications. It's almost kind of like the back of the television. You don't really know what's going on there. You're just kind of looking at the front of the screen. Or with email, like, you just send an email, it just works. You don't think about using SMTP. So you're seeing a world today where what's happening is very real. And I've been following the blockchain space and investing in it since 2013. And I've been broadly skeptical about most things in the space. And I think most experiments have not played out. But what's happening now, particularly around DeFi, is very real in my mind.
So we do need to transition. We'll come back, as we said, we'll have always an informal discussion in the back half hour after Yusuf sets the tone. I threw some slides up here that Stephen Burke, I'm not going to make him talk. In fact, you're not allowed to talk, Stephen, unless you really want to, because you talk. I make you do it all the time. But he did provide some slides and to put this in context from the central bank perspectives. So I think this is a great debate. As Ben said, this is happening whether you want it or not. This is going to happen whether the U.S. wants it or not. So let's be aware of it and think about how to play it. And then as I transition over to you, Yusuf, there's a theme that we had a couple weeks ago. We all listened to Kissinger's, well, not all, but some of us listened to Kissinger's interview with the Economic Club of New York. And Bill Deukler showed some slides that are slightly similar to what you're about to show, talking about the importance of GDP relative to the economy. Kissinger said that with weapons that think for themselves, nuclear weapons are child's play. And the key is, the technology is really truly king. And his thought takeaways were how is that, multipolar world look like? Who has control of these platforms, so to speak? And so I think that sort of segues over to you, Yusuf, and I'll just remind everybody your background as you go forward.
Do you want to take over the screen share?
Yeah, go for it.
Okay. Bear with me here 1 second. All right, can everyone see me? Show a picture of Xi and Putin on the front. We good? Good.
Yeah.
All right, my name is Hamlet Yusuf. I'm one of the managing partners at Iron Gate Capital Advisors. Mark, I want to thank you for the opportunity to address the group here. We want to really take this as a point of education and helping family offices and investors become aware of an ecosystem that we specialize in, and to kind of expand on some of the things that we just heard. The adoption of technology and the pace of change that I think is coming at us is going to be breakneck over the next several decades, probably over the next decade specifically here. I think the future, the immediate future, 10 years down the road, whether you're looking at finance or you're looking at tech, consumer, is going to look completely different because of some massive tectonic changes we have coming our way in the way of disruptions in technology. What we do is we focus specifically on technologies that have a direct impact on national security and defense. We'll get into that in a little bit of detail here in terms of what our optics and views are in the world today. And I'll probably update the slide after either next week or January once we figure out who wins the presidency to have the third head up there. But this is a quote from the Brookings Institute that basically paraphrased direct comments from both Xi and Putin. And we'll read it verbatim. Whoever leads in artificial intelligence in 2023 will rule the world until 2100. So basically, the view is whoever gets to a point of dominance in key technologies like artificial intelligence, like quantum computing, like hypersonics, is going to be able to dictate geopolitics in the 21st century. And to go on to follow up on the slides that Mark just showed, let me give you all a quick history of kind of how things have shaped up since the onset of the Second World War into the Cold War, post-Cold War, and where we are right now, which many politicians, scholars, think tanks call the great power competition. Cold War kind of at its height in the late 60s, late 70s, early 80s. You saw that the United States was a key driver of spending in R&D, particularly in technologies that would impact the national security and defense. A lot of that innovation, a lot of that R&D was being done through groups like the Manhattan Project or the major defense contractors or the labs associated with the federal government. Not a lot of it was being done at kind of the venture, startup, private sector level. What you started to see in the last 20 years, 30 years, going back to the post-Cold War era and where we're at today, you're starting to see the U.S. fall behind in terms of where our R&D dollars and how much of that is being driven by the federal government, but more importantly, how much of it is being driven in particular here by China. I think both Russia and China have looked at what happened in the 20th century. And in the 20th century, I think the West, and particularly the U.S., was able to come out ahead in the Cold War because we outspend the rest of the world in terms of innovation in key areas like nuclear, like computing power. And as a result, because the economic and political security that the West had, we were able to win the Cold War. And I think you're starting to see that same kind of dynamic kick off here, the great power competition in the 21st century. What the great power competition really talks about is after 9/11, the U.S. was focused on one thing and one thing only, and that's counterterrorism. We had two hot wars in Afghanistan and Iraq. And I think what happened geopolitically is the West kind of took their eye off what was happening with China and Russia. And what we see now is a reemergence where the geopolitical driver is not going to be counterterrorism. Counterterrorism is still an issue. It's an issue that I think, regardless of what part of the world you're on, we got to work together on to solve. But you are seeing a kind of like superpower, like great power competition reemerge now. With us as a fund, our view is this technology arms race, or this great race around technology, falls into some very basic buckets, and each one of these can be dissected some more. But where we focus our thesis on, and where we think a lot of that disruption is going to happen, is going to be in these 5 areas. You have data analytics, artificial intelligence, cloud processing. This also captures computer vision, AI, quantum computing, unmanned systems and robotics. That's going to be a bigger focus, I think, as it relates especially to the DoD. I think the columns of tanks coming over the berm are over. I think the future of warfare is going to include a lot more autonomous systems, both on the ground, in the sea, as well as in the air. ISR, or intelligence, surveillance, reconnaissance. These are large-scale data collection platforms, whether they're terrestrial, out in space. Think of this as industrial IoT. Critical infrastructure and key resource protection. This touches not only banking security and cybersecurity, but also our grid system, food security, and water security. And an area that touches all facets of these 5 food groups is cybersecurity, both offensive and defensive. If you break down what the opportunity set looks like, this is some key excerpts from the DoD budget. Full fiscal year 2021, the target is going to be north of $700 billion budget for the DoD. This is an increase over the last 2 years. You can see some subsegments of this: hypersonics, 5G and telecom, autonomy and artificial intelligence, collectively make up anywhere from probably, I'd say conservatively, $5 to $7 billion, if not more. This is specifically what the DoD is looking to spend on. In terms of cybersecurity specifically, I think about 10 billion of it is going to be focused on cybersecurity. Enterprise-wise, I think globally you're looking at $123 billion is going to be spent on cybersecurity. This, I think, helps demonstrate what the value of the market or the opportunity looks like. As an early stage investor, I think you're successful if you focus on 2 things. One, investing in segments that you have deep expertise and bandwidth and knowledge to be able to identify and vet proprietary deal flow. The other part of it is you obviously want to invest in a sector or a segment that is about to go through some hyper growth. And I think that's what we're looking at. When we started talking about this thesis a couple of years back, the general consensus was this is much more of a right-wing focused fund, or much more of a Republican-friendly fund. I think that's not the case. I think regardless of what happens next week. This is an area that both domestically and globally is going to garner a lot of attention. We've been privy to a couple of calls with other venture funds that are involved in the national security ecosystem, as well as some folks with Obama's former NSC administration and likely influencers should Biden come out victorious next week, and their areas of focus, should they come to power, it's not going to be to massively gut and cut defense spending, but it's going to be reallocate some of the spending dollars away from old 20th century legacy programs into some of the key areas that we talked about here that are going to reshape the 21st century. So regardless of who's in power in the US, I think this is a sector that's poised to do, I think, phenomenally well from a growth standpoint. Just to put into perspective, and this number has been bantered and debated quite a bit. If it's 70 billion, it doesn't matter compared to what the DoD is spending. The 2021 budget, which is a very hawkish, bullish budget, the DoD is targeting just under $1 billion in spending in R&D and development for artificial intelligence. The Chinese government, in a whole of government approach, is looking to infuse $70 billion in 2020. That's up significantly from 2017. That number, if you cut it in half, it's still significantly bigger than what the U.S. is doing. And this really underscores a key importance and a driver of what's going to reshape or drive this ecosystem in the 21st century is the DoD. The Defense Department has been very vocal to the fact that, with the exception of controlling innovation in key kinetic technologies, things that make things that go boom, like weapon systems and stuff like that, the DoD is going to start relying heavily on the private sector to be a driver of that innovation. Simply put, they can't compete dollar-wise and innovation-wise. They need to monopolize or incentivize the private sector to get involved in this space. What's changed, and going back to the slide I showed earlier, the innovation and the R&D was driven primarily from government out, and any private entities that were involved generally tended to be the large defense primes. That's what drove defense spending in the 50s, 60s, 70s, and the 80s. What has changed now is a lot of that innovation, a lot of that breakthrough is not happening at Lockheed Martin, at Raytheon, at Boeing, at Apple, at Facebook, or at Google, or Oracle. It's happening at the entrepreneur level. It's happening at the startup level. It's happening at the mid-level engineer who left Google or who left Facebook or who left a tech company or who left NSA or CIA, and they're forming a company and a startup that addresses key gaps within that ecosystem. So you're starting to see a significant surge in startup formation and funds that are focusing on this space. More importantly, from a staying power standpoint, you're starting to see more and more companies, or not companies, more and more entities associated with the Defense Department that are being stood up and have been stood up over the last several years, focused on bringing innovation from the private sector into government. Specifically, InQtel, venture arm of CIA, been around for over 20, 30 years. They're very active in this space. Under Ash Carter, President Obama's former defense secretary, you had a group stood up called Defense Innovation Unit, experimental. Their job was to engage private sector venture in Silicon Valley to get them to drive innovation in the DoD. Not par for the course. DIU is still around. They dropped the X. They're now DIU. So they've stayed through the Trump administration. So, and it seems like every month we see another entity coming out of Defense Department or NSA or CIA that's forward facing and wants to engage the private sector. So what that tells me is the DoD is fully vetted, at least for the time being, in engaging the private sector in terms of bringing innovation into this space. So what do we mean from an example? And I think show and tell is probably the best way to talk about this. Red 6 Aerospace is one example of a company that is right now experiencing some initial success in this space. It's a company that we're an investor in. It's a company that we found at a private Air Force conference about 2 years ago. And what they do is they're basically building a flying virtual simulator. So you think about the movie Top Gun, when Maverick is out trying to fly and fight against a bunch of bogeys. I mean, those are actual Russian MiGs or actual adversarial aircraft that we had to go ahead and steal, operate, and and fly. What Red 6 has created is they've created a helmet that goes over the airman's visor. It ties into the instrumentation of the airplane. So when the airman is doing a dogfighting exercise, when he or she looks out of the airplane, the adversarial aircraft isn't flying next to them. It's an actual augmented reality, virtual reality projection of that aircraft that they're fighting against. It's a multi-billion-dollar savings for the U.S. Air Force. It has massive applications from a defense standpoint, but more importantly, not only does it help address a mission-critical need for the federal government, it has massive applications for the entertainment and for the gaming and private enterprise as well. So when we look at some of these technologies that I think are going to reshape and impact the DoD, the ones that we're looking at and the ones that get us excited aren't the ones that are one-trick ponies and only address a certain need for, let's say, the special operations community or the Navy or CIA or NSA. We're looking for technologies that impact national security and defense, but have significant scalability, use, and adoption in the private sector in other segments as well. Some examples of companies that you all may or may not be familiar with. There's a whole bunch of them. But these are 6 companies that I think a lot of folks are somewhat familiar with. We as a fund are not investors on any of these 6. This is more meant to represent what this ecosystem looks like. Everyone's familiar with Palantir, Peter Thiel's company. Palantir was initially seeded by CIA and a handful of investors back in, I think, 2004, 2005. I think it's a $4 or $5 million check. The company obviously just went public, $20+ billion valuation. You can read for yourself on some of the valuation upticks here, but SpaceX, everyone's familiar with them. It's Elon Musk's company. But Anduril, Palmer Luckey, former founder of Facebook, he left Facebook a couple of years ago, and he is building what a lot of people think is going to be a defense contracting firm of the 21st century. They're doing a lot of interesting work in terms of augmented reality, virtual defense, virtual border protection. Shield AI is a up-and-comer. It was started by a couple of former Navy SEALs. This is an example of how a disgruntled middle-level government employee leaves and decides to create a system that works better than what they were forced to fight with. But what Shield does is they have an ability to manage and navigate a fleet of drones into the battlefield, but also can be applied for like an Amazon warehouse or for oil and gas sector. So a lot of dual use applications. Hawkeye 360 is a mapping technology that is fast approaching unicorn status. Dragos is a cybersecurity company that's coming out of the national security space that's doing some tremendous work in the grid and infrastructure security space. Regrettably, I know the founders of Dragos, and back when I was forming and standing Iron Gate, I had an opportunity to potentially pick which route I went. And I was going to be an early member of the sales team at Dragos, but I wish them the best of luck. But this, I think, represents what is, I think, a very vibrant ecosystem. It's a hard ecosystem to get into because you need the requisite accesses from a clearance standpoint and a relationship standpoint to get some good clarity in terms of what kind of companies and technologies are going to cross the chasm and gain adoption within the DoD. So I think you got to be very diligent in terms of who and what you invest in and with. Everyone is going to tell you got traction or they have traction with the DoD. I think it takes a special bit of diligence to be able to really vet that out. So being partnered with the right fund and the right investor, I think is critical. But I think what you've seen here is a pretty comprehensive presentation, not only from us, but from the prior presenter about some significant disruptions that are happening from a tech standpoint. We're touching on 2 different segments here, but I think with disruption and with massive change, I think investing with partners who have deep insight and access to that disruption is key. So I can easily talk about this for the next 2 hours. Do not want to. So want to shift the conversation to Q&A, and Mark, I'll relinquish the screen share.
That's great. Thanks, Hamlet. So questions on what Hamlet covered? Don't be shy.
Thank you for a very good presentation. Can you please tell us how you do due diligence of this projects?
Yeah, we rely on our extensive network. We have deep relationships within the Defense Department and within the U.S. government, folks that have security clearances that can help us vet certain opportunities, trends, or companies. Our team is made up of a interdisciplinary mix of people from not only the venture and the private sector, but people who have actually served in government. So having that bona fides, I think, helps significantly in terms of vetting and diligencing deals and opportunities.
Hey, Hamlet, Jerry Conley, what is our biggest blind spot in this massive tech growth where we're really lagging and we need to focus on?
That's a great question. It depends on who you ask. I think we have better AI systems than China. I think China has the potential to defeat us. We're as right now probably ahead in that race, primarily because of simple numbers. It doesn't matter how good your algorithm or your AI machine or your AI tech is, if you don't have the training data to push through to help it learn, that's always going to be a disadvantage. China, by pure numbers, has us in terms of people. So they have access to, I think, larger training sets and training data. And that whole thing of privacy becomes a question. We have a much more of a libertarian society, so privacy and user data controls are big and pretty important. Obviously, very important trend in Europe. China, not so much. In terms of Russia, Russia's always been stellar in terms of cybersecurity and space. So hypersonics and cybersecurity, I think, is a key area of concern. So I liken this technology arms race between the West, Russia, and China more as a long distance marathon. We're probably about a third of the way in there, and depending on when you're paying attention to it, the three of us are kind of in the same pack. And in some areas, one of us will break ahead and the rest of the pack will catch up. The importance on artificial intelligence and quantum computing particularly, though, and this is where I think going back to that opening quote from Xi and Putin is so critical. We're going to wake up one day, and there is going to be a Sputnik moment where we're going to realize, holy smokes, we're behind. With the pace of change of technology, we had time to catch up and course correct that in the 20th century when we had our Sputnik moment. But we could get to the point where we see that China or Russia or the US is light years ahead in terms of AI and quantum computing. And if that happens, that gap at that point, I think will be too great where it won't be closable, particularly the quantum computing, going back to the question that was raised earlier. When that breakthrough moment happens in quantum, it's anybody's guess. It's anywhere from 2 weeks to 20 years from now. But when that does happen, you can encrypt everything and you can decrypt everything. So imagine what that does from a disruption standpoint.
Thank you.
Other questions?
Mark, can I ask one?
Sure.
Hamlet, if you were the next president, how would you take the budget of the 740 that you mentioned and reallocate it to ensure that we are on better footing?
Yeah, and this is where I think both the Republicans and the Democrats, for the most part, actually agree on it. There is a bit of a fiefdom within the old guard of DC wanting to continue to invest in old school 20th century legacy programs, but I think both Trump and Biden have talked about reallocating some of those dollars and reemphasizing putting the money to work in key areas like autonomy, quantum computing, AI. I would for sure, obviously, focus the attention there. We don't need another A-10 tank killer. We don't need another Bradley tank. I think the war of the future is not going to be, like I said, columns of tanks and Jeeps and Humvees coming over the berm. It's going to be a fleet of autonomous vehicles. Having a fleet of autonomy vehicles, I think, is important. But the reason why you need to focus on cybersecurity and AI is those devices need to be able to fly, coordinate, and communicate with each other. The human brain can't do that. So I think you need coordination of systems. AI becomes critical. Quantum computing becomes critical from an entanglement standpoint. And then if you have a great autonomy military, it's worthless if the adversary can hack it and take it over and use it back against you. So those are I think key areas. I think the Russians know that. I think the Chinese know that. I think we know that. The importance of this space, there's a really good reason why us and the Soviets never got into a hot Cold War or a hot war in the 20th century. We both looked across the table and realized that the other side had immense power to wipe out the other. So the old concept of mutual degree destruction, I think, was real. I think that same doctrine is going to shape the 21st century, where the Chinese, the Russians, and the Americans in the West need to look at each other and realize that each one has its own capabilities to take down another country's infrastructure, or has a comprehensive fleet of autonomous vehicles and devices that could cause some significant damage. So you're always in that tight arm race to make sure that you're on par with your peers, if not ahead of them, because I do believe in Reagan's mantra of peace through strength. That drove the 20th century, and I think the 2.0 version of that is going to drive the 21st century.
And just as a follow-up to that, beyond the big three, how do you view your concerns around North Korea, Iran, and some of the other potentially bad actors in your outlook?
Yeah, I think Iran is North Korea. I think is a manageable issue, because I think neither the U.S. or China wants a North Korea that's out of hand. So I think there is a mutually beneficial appeasement policy that I think we can achieve with North Korea. I also think the leadership there, we've got to hope, is somewhat pragmatic and believes in self-preservation ahead of bedlam. And when you're the king of a hermit kingdom, I think you kind of want that. So hopefully that'll play in our favor. Iran's a different question. Iran, I think, is going to go through their own geopolitical issues in terms of understanding who's in charge of that country. But from a cybersecurity standpoint, they're stellar. I mean, there's open source reporting on the comprehensive attacks that they've been able to launch against our banking system, particularly JP Morgan and our grid system. And I think most recently in terms of some of the election meddling coming out of Iran. Iran is part of obviously a greater regional issue. You have Turkey, you have the House Assad, and you have the Iranians right now that are vying for power and influence in the Middle East. And what was a traditional Middle East-Israel conflict, I think, has been significantly complicated. But I mean, Iran, I think, realizes if they do get to a position of breakthrough in nuclear, it changes their ability to project defense.
Thank you. Great presentations from both of you. Really, really great. Thank you.
Great. Thank you.
I have a question regarding 5G, and given that a lot of these technologies are going to be reliant on 5G.
Yep.
What's your opinion on dual tracks of 5G and ending up with segmented systems in different parts of the world, given who each of the countries are allied with?
I think you're probably going to see something along those lines, where the network is going to be controlled or influenced by who's got geopolitical influence in that arena. Because if you own the 5G infrastructure, you can now potentially siphon that data off and do with it as you wish. And I think with computing power and quantum and AI developing at the pace it does, more and more of that data does become exposed to being compromised and being dissected and analyzed, regardless of how it's being encrypted. So I think that's a real threat. Longer term, beyond 5G, this is the importance of commercial space. There's a lot of efforts right now by the West as well as China to put low Earth assets in space that will provide broadband interconnectivity for the masses. The critical importance there is if you do have a country that controls the infrastructure, what happens in terms of what they allow and don't allow in terms of access. Think of China, think of North Korea, think of Iran, think of Russia. They've all talked about having their own intranet where they control what goes on that for their own masses to see. That's a scary thought, because anecdotally, if you walk up to a teenager in Beijing and ask them to tell you about Tiananmen Square, a lot of them aren't going to tell you what happened back in the turn of the century during the events that happened in Beijing. So to be able to control information becomes a significant challenge and issue. I think it's a reason why China has an intent effort to not only get that infrastructure up and running, whether you're talking about 5G on the ground or eventually terrestrial, because they want to create that free internet, so to speak, for the world. But then that gives them a platform to be able to control the information that goes out there.
Thank you.
Other questions, again, for either Hamlet or for Ben. There were some questions in the chat. Maybe I'll just repeat it. What was it, Jerry? You had asked about Carlyle's blockchain bet and acquiring Calitone. You want to expand on that question, or do you want to comment on that, Ben?
No, I just, they made an acquisition this week. I don't know if it's their first foray in it, but obviously that's a big player in the space. Calitone is a UK company, but just be interested in any thoughts there.
Yeah, definitely. Yeah, I saw it. It was, I haven't candidly dug too much into Calistone, but effectively what it sounds like, and there's, you know, that particular vertical is, there are several companies building this, is effectively platforms that enable trading of digital assets or tokenizing kind of more traditional securities like stocks, bonds, treasuries. So you can effectively create efficiencies around settlement and trading by using distributed ledger technology. They're kind of one of the first, and I'm not sure where they are. Calistone is in particular in terms of like their product development cycle. But there are several other companies that are kind of chasing that broader market. It's interesting to see someone like Carlyle make a bet in the blockchain space. I was previously at TPG and KKR before launching Perify, and I can tell you, like, there's an increasing amount of interest from more traditional kind of investors across private equity and growth equity in the space, which is, I think, an encouraging sign.
Thank you.
Other questions on either front?
Yes. May I please ask you your view on the actual term of your fund? Because in essence, what you're talking about is a B2B solution, which will take years for an approval. But then the question is, how quick will be the adoption? And you mentioned that the same technology can be used in B2C, but then how does it work? Does the DoD provide this permission, or what else is happening for us to understand the whole process of success, of getting to success by the portfolio companies? Thank you.
Yeah, you've seen as a significant change in the 20th century. It was all about government spinning technology out. So it was created in government, used at the Pentagon, perfected at the Pentagon, and then taken to the private sector and then monetized there. Examples of that are the internet, point-to-point communications and encryptions, related technologies, Google Earth. Those are all examples of technology, GPS, that was perfected in DoD and then taken to the private sector. What you're starting to see now is you're starting to see the concept of spinning in, where government is actually taking companies that are creating commercially viable technologies for the private sector and for enterprise or consumer, modifying that technology to meet certain needs of the government, and then bringing those technologies in. In some cases, like a Palantir or an Anduril or a SpaceX, a bulk of that early work is going to be DoD centric, and then eventually going to have potentially a private sector application. Not sure if Anduril will or not, but for sure Palantir and SpaceX. But you're also starting to see, and what gets us excited is when we start seeing early commitments from government to the company, where they put together various rounds of dilutive and non-dilutive financing for the companies to incentivize them to get their product to market for specs within the military. But it's also, to your point, why if we are going to invest, we almost always want to have a company that has a real midterm line to profitability, just on the private sector or non-government piece, and the government piece is an added bonus for us.
There were some questions in the chat, Ben, about JP Morgan, what they're doing. Did anybody want to shed light? Nisa, you were sharing that link. Do you want to comment on that?
Yeah. sorry, I can address JP Morgan. I don't know if the person had a question. Yeah, so we're seeing and kind of the early stages of an arms race to effectively kind of control this stablecoin market. And so again, the idea of a stablecoin is really simple. Take a dollar, tokenize it, and put it on the blockchain. And you can, from a kind of government standpoint, you can effectively surveil economic activity in a way that's currently not possible because you can't surveil cash transactions. It's more difficult to surveil activity running through banks. And so we've seen, and I think you'll kind of increasingly hear the acronym CBDC, Central Bank Digital Currency, where you'll see the Fed, the BOE, others tokenize their own currency. You've also seen kind of banks undertake this. So JP Morgan has created JP Morgan coin. And the idea there is it's a settlement layer. So you can go, it's easier to send a digital dollar for payments, for just settlement, for trade financing than it is to use SWIFT. So they've, and use partner banks in foreign countries. So they recently launched JPM coin. You're going to see other banks kind of get into this game too. Libra, which is Facebook's digital asset, is still, they have a 100-person team kind of focusing on developing it. That, we'll see if that actually launches, but if it does, I think it could be pretty disruptive. And so the next evolution of that is, hey, if you're going to have a digital asset, you've got to enable custody and enable people to custody that digital asset. And so you've seen now JP Morgan in the market looking to acquire custodians within the digital asset space. And that's, I think there'll be significant kind of consolidation within the digital asset custodian market in the coming years.
On that same vein, I think it was earlier this week, the PBOC laid out a draft law where they're incorporating the digital renminbi into the system in circulation. A couple of the articles in that draft law addresses directly the banning, I may not be using the right word, but of issuing and selling digital coins, stable coins outside of the realm of the digital renminbi. Do you have any? I mean, there's a couple of questions I think in the queue there on the chat that are alluding to similar things. Do you have any reaction to that?
Yeah. Well, so so I think what you'll see is the PBOC. This is like a great tool for the PBOC from their standpoint because they can effectively, like give up financial privacy and they can surveil activity within their economy and control and enforce sanctions and understand kind of detailed consumer behavior. And so I think blockchains to that end will be used by state actors in that manner. You also have kind of non-sovereign digital assets like will challenge these kind of state-run digital assets. So I think what's interesting is the issue and print money of what's interesting here is like blockchain is kind of non-sovereign currencies are kind of disrupting that precise power at a time where kind of trust in governments is at an all-time low and central bank monetary policy is kind of been, growing exponentially over the last 10 years and shows no signs of stopping. And so we're kind of reaching this state of the world where people are kind of questioning kind of how governments are going to pay back their debt, and that's kind of where Bitcoin enters in a sense. Is it's seen as kind of this apolitical, like non-sovereign asset. It's kind of like gold, like, you know, similar thesis to gold, but arguably kind of bigger market. And so I don't necessarily think about the PBOC or central bank digital currencies as necessarily being kind of competitors to something like Bitcoin. They'll run on the same infrastructure, but they're still subject to monetary debasement and inflation. And so ultimately, like, they're just kind of using blockchain as a technology, but not necessarily, you know, you're still taking risk if you hold those assets. And so that's kind of where Bitcoin, I think, becomes interesting.
Thanks.
Others before we break? Stephen, you seem to jump back on. You have any other comments?
No, thank you for a change.
Joe Azzaro, any summary thoughts before we break? You're on mute.
Gotcha. I thought this was great. Really enjoyed kind of hearing the different points of view from Ben within crypto. I don't know if you guys touched on, if you just saw Chaz Walker's comment related to stable coins, but yeah, I thought this was a really good presentation, and appreciate all the time.
Chaz, do you want to raise that question?
Yeah, Mark, if I could, thank you. And hopefully the ambient noise behind me isn't too bad. I'm in the park today. With respect to stable coins, I wanted to try to understand more about how stable coins are being perceived in the payment sector, and then as a cash management tool. And then secondly, I wanted to sort of get views on what's the next evolution in stablecoin that would lead to its increased adoption by non-bank financial services players, because I think the banks aren't going to want to adopt because they're going to want to control. And so I'm expecting that the innovation is going to come first outside of the traditional banking networks, because I think there's a competitor to SWIFT here. So those are my two questions. Thank you all. Great session.
Yeah, those are great questions. So when you think about kind of stable coins, I kind of put the stablecoin market into two buckets. So there are fiat-backed stablecoins, which effectively, if you own a stablecoin, it's backed by $1 in a bank account somewhere and is redeemable for that dollar. But ultimately, if you hold that stablecoin, you're taking the counterparty risk of the holder of that bank account. Then the second part of the market is decentralized, algorithmically pegged stablecoins, where you are not taking any counterparty risk, and you own a digital asset that holds a $1 peg algorithmically and is backed by significant amounts of non-stable coin collateral on chain, something like DAI, which is a byproduct of the MakerDAO system. If you think about kind of where the market is today, I mean, the majority of stablecoin supply, which today stablecoins are roughly $25 billion market, the majority of that, 80 to 90% plus, is in the kind of fiat-backed centralized stablecoin market, and if you think about kind of what these are, like, are they securities? There's been a lot of debate around that question by regulators. I mean, ultimately, a security is something that you hold with the intention of making, of earning profits. And so usually people are holding stablecoins not with the intention of earning profits, because the price tends to be stable. It's effectively just a dollar substitute. So I don't suspect that they're securities, although some may disagree. Just like kind of US dollars are not necessarily securities, they're currencies. So I think where this is all going is you kind of see these stable coins that are used to, there's a theme around dollarization in emerging markets. So you see countries with high inflation, you're seeing people choose to hold stable coins instead of their native currency. You saw this with Bitcoin in Venezuela and Argentina and certain Latin American economies a couple of years ago. The issue is, you know, if the Argentinian peso is depreciating 30, 40, 50% month over month, that's not very good. But, you know, Bitcoin is also quite volatile in and of itself and had a decline of 85% in 2018. And so it's kind of picking your poison. What's interesting about stable coins is like you can effectively get US dollar exposure in Latin American markets or any market with high inflation. 15% of the world, over 1 billion people globally live in countries that have over 15% per year inflation. The idea of kind of getting their hands on US dollars is attractive. And so that there's a theme around kind of dollarization in emerging markets. Then there's also a theme around kind of this B2B use case for stablecoins. So the idea of, you know, let's pay our remote workers using stablecoins because it's more simple and easier. Let's pay international vendors using stablecoins because it's simpler and easier. And so I think I mentioned this earlier in the call. You know, we use stablecoins to fund deals. We use stablecoins to settle transactions if we're trading over the counter. We use stablecoins to pay invoices. It really simplifies the process. You don't have to type in wire information. You don't have to ask or question if the wire got lost, or check with banks or pay fees or wait, you know, 24 hours for the transaction to settle. It's just much more efficient. And so that's, it's pretty, you know, it's a very early kind of technology in the sense that there's, you know, it's still only being used by maybe a few 100,000 people globally. But I think stablecoins in some way are this Trojan horse that's going to bring a lot more interest into the space because it's something that everyone can kind of relate to, which is the pain of sending dollars in today's economy tends to have a lot of friction, and you can eliminate a lot of that with just by using stablecoins.
Yeah, especially in emerging markets where many governments are faced with dollar shortages. And basically they're crippling their economies because they're short that dollar liquidity, particularly the energy and commodity driven emerging market countries.
So Bill Deukler, you said you wanted to amplify that question?
Sure, just a somewhat of a side comment. Yeah, all the things on stable coins, you know, absolutely, it's a great way to take out costs. And sort of, you know, you remarked about a potential replacement of SWIFT. There's a company that the firm that I was with previously invested in called Figure, which has built a blockchain that is a functional replication of the DTCC. So it's not SWIFT, but you know it's essentially the settlement network, you know, for securities, and they've been able to accomplish T0 settlement and cost reductions of about 40. I think it was around 40%, something like that. So it's, you know, for people in the financial business trying to wring out more efficiencies at a lower cost, it's a really great solution. And you know, they're beginning to see, you know, more traffic, you know, on that particular part of their business. So, you know, I think between stable coins, continuing to use blockchain infrastructure, you know, one other example in trade finance, as I understand, a London-based company called Marco Polo, which is a big player in trade finance, has partnered up with MasterCard to do a blockchain-enabled settlement layer for trade finance, which right now is like a lot of faxes, a lot of paper moving around, and they're hoping to take out a meaningful percentage of the friction in that market. So I think, kind of generally speaking, you know, blockchain technology has got a huge potential. Everybody thinks about it in terms of Bitcoin, but it's, I think it's, as Ben has said very well, it's far more than that. And we're just at like the top of the first, on that one.
And that was Marco Polo and who are doing
Marco
that?
Polo and MasterCard put together
Interesting.
kind of a joint, I wouldn't say a joint venture, but a cooperative program in order to, to bring a blockchain-enabled solution to trade finance, which is, I think it's like a $1.3 trillion market, and there's about $500 million annually in frictional costs that they're hoping to wring out of that.
Yeah, great point. I mean, we're actually also investors in Figure.
In Figure?
Yeah, in Figure. Actually, in the digital, the blockchain that they've launched, the Provenance blockchain.
Provenance, yeah.
There's a digital asset behind it called Hash, and basically every time a loan is settled or any activity takes place on the Provenance blockchain, fees get paid to hash holders. So you're effectively owning kind of the equity of this network. And it's really interesting. I mean, they're experimenting. It's almost like a new kind of, it's almost like a financial utility in the sense that you could see this evolving. It's this settlement layer, to your point, like DTCC for all assets, but it won't be owned by, it'll be owned by hash holders,
right,
who kind of oversee the network. Right now, Figure built it, but eventually it will be kind of this, it'll be owned by a consortium of different banks and investors, and it's kind of this neutral settlement layer that has a lot of potential.
Yeah.
Hey Ben, I'm curious of your thoughts. Like most industries that are new, highly fragmented, and in looking at this tsunami that's here and growing, what disrupts it? What are the risks as you sit and think about the major risks, whether they're government-driven risks or other commercial risks? How do you think about the risks?
Yeah, I think the two biggest risks to the broader blockchain space are regulation and underlying kind of technology or smart contract risk. On the first point, we talked about regulation earlier. I think that every government is going to come out in a different place on blockchain. Some are going to say, hey, we don't want it. Others are going to embrace it. And there's a little bit of game theory involved, because I think the ones that embrace it are going to see a lot of job creation, a lot of efficiencies, a lot of, just general wealth, wealth and capital appreciation within their economies. Others will take the opposite view and say, hey, we're not going to embrace digital assets or cryptocurrencies that are non-sovereign, but we will issue our own digital asset, and we'll use blockchain as a technology, as a surveillance technology, kind of similar to what you're seeing in China. China currently does not allow banks to, they're effectively regulating the on-ramp for people to enter the crypto economy. Once people do own cryptocurrencies, the one important thing to note is no state actor can stop them from sending, their Bitcoin from one address to another. It's completely permissionless and open by design. Bitcoin is unique, and all digital assets are unique in that they're unseizable assets. They're really the only unseizable asset that exists. So, if you think about other assets, stocks, your bank account can get frozen by the government. Your Fidelity account can get frozen or seized. So stocks, private equity, public equity are subject to kind of the judicial system. If you have fine art, that can get seized, or physical gold that can get seized. The interesting thing about digital assets is that they're fundamentally unseizable, and you can kind of cross borders with billions of dollars just knowing a certain password. So it's because these things kind of transcend borders and governments, and so it's a very kind of jarring idea or concept to governments that people can cross borders or take these actions without without their ability to kind of surveil that activity. So I think, look, there's a lot that has to be figured out from a regulatory standpoint, but if you kind of just see and listen to different governments, like they are really embracing this technology and really see it more as a tool than as a threat. Similar to like the internet was also a threat to governments because it allowed people to share information that wasn't necessarily favorable and connect more easily. And so, look, I think I think it's both a risk and an opportunity, just like any other technology. I think on the smart contract technology side, there are things like quantum computing, which may or may not actually pan out. There are things like just underlying kind of code risk in these networks. So they tend to be quite complex to interact with. But I personally don't really see much derailing the progress that's taking place in the space. The train is very much like left the station. I don't think it's actually the first inning anymore. I think it's kind of more like the second or third inning, at least from a technology standpoint. And I think the space is going to move very quickly. I mean, it already is moving quickly. The biggest companies in the world and governments in the world are making material investment in the space. Fidelity, the New York Stock Exchange, Facebook, JP Morgan, PBOC. I mean, these are like the biggest, most powerful organizations in the world. And so it's kind of emerged from being this niche technology to something that's, much bigger.
Hey, Ben, real quick. At what point was the light bulb moment for you where you kind of just said, okay, because you have more of a traditional finance background, right? At what point did this kind of snap for you and you said, all right, this is the future. I want to get in on this and really commit to it?
Yeah, well, so I stumbled across Bitcoin in 2013 and I said, hey, this is kind of an interesting idea. It's kind of a non-sovereign store of value. It's uncensorable money. And this was 5 years into this current wave of quantitative easing and fiscal stimulus coming out of 0809. And I'd always questioned, like, hey, how is the government ever going to repay its debt? Can the Fed inflate its balance sheet into perpetuity without any consequences? And so Bitcoin was kind of an interesting experiment in my mind, but it was limited in terms of kind of what it could do. And it was at the time very niche. And then fast forward to 2017, and you saw this kind of this idea of Ethereum, which is it's a neutral database, this neutral computer that anyone can build on, and it had more expressivity in terms of what you could do relative to Bitcoin. So the first thing that caught my eye was this idea of an asset-backed lending facility where someone could effectively, it kind of is similar to a kind of a revolving credit facility or swap line in kind of the economy today. The idea where if you have an asset that's worth $100, you could pledge it to a smart contract and borrow against it if you wanted to, if you needed credit or working capital, and you could kind of manage that borrower-lender relationship using code instead of traditional capital markets. And that was kind of the light bulb moment for me, where I saw there was a very vast design space for financial activity. Because if you think about most of finance is really just if-then statements that are programmed into legal agreements, whether it's like a call put option or a lending agreement or a futures contract. All these things are just if-then statements, and you can effectively program them into code, and they can operate more efficiently without intermediaries. And so that idea of kind of programmable finance got me excited. And when I was at KKR, I was leading internal research around the blockchain space, but then very quickly realized, this was more than a full-time job to keep up with, and I had to, live and breathe it every day. And so I ended up leaving to do this a few years ago.
Thanks. So I don't know if we lost Mark, but does anybody else have any other questions?
I put myself. I was just saying, although I hear an echo, that this has really been a great thing. One more in a series of catalytic discussions with smart people. And thanks, Ben. Thanks, Hamlet. And that I would think you each deserve your own deep dive, but we sort of threw you together. And thank you everybody for the good questions. I think our fintech group, we'll keep expanding, and there's some people that are on the screen that couldn't make it today, but and then we have some global perspectives. I told Yusuf, just be careful. I've got a lot of Chinese families in and I spent 8 years in Russia. So in any event, hopefully we'll find the commonalities, do things together. So thank you everybody, and then we'll be in touch soon.